There was a time when the quantity theory of money was considered very important.
Right.
Right. In the last 30 years, globally at least, people have stopped looking at, or at least central bankers or monetary theorists have stopped looking at the quantity of money.
And what is the quantitative theory, if I may ask?
Basically, that how much money is there, right? So, how much is M0, how much is M1, how much is M2, and I guess we'll discuss that at some point. But how much money exists in the economy
Right.
Was at one point considered very important to control things like inflation, because if you print too much money, then there's only so much economic activity, then the money gets debased, gets devalued.
Right.
Now, in India, what I think the RBI targets is to have a certain level of base money, which is growing at this more or less the same pace as the nominal GDP.
Right.
So basically, nominal GDP being value of activity and the pace at which it is growing. Because remember that money is needed as a medium of exchange, and therefore there has to be sufficient money for the economy to function. And there, I must give you a very interesting example. The first historical evidence of quantitative easing was in AD 30, when the Roman Emperor Tiberius,
Right.
He was so efficient at tax collection, and at that time there was no paper money, and there were no electronic and digital money. So it was only physical money, which was coins.
Right.
And he was so good at tax collection that his treasury was full of tax, right? And there was not enough money in the economy. And then the economy started slowing down.
Right.
So what he did was he then lent money to the patricians, basically the elites, who then started spending that money, and the economy got liquidated. So there is a certain amount of money that you need for the economy to function properly. In general, sort of having a rule of thumb where nominal GDP and base money growth are sort of in line or maybe close to each other is a reasonable assumption. But the better measure is at a broad money level, right? Basically, see, M0, which is the base money, is currency in circulation plus bankers' deposits with the RBI. If you add to that demand deposits, and then you add to that the time deposits, you actually get to M2. So M2 growth, or in India case M3 growth, I think if it is in line with nominal GDP growth, then you have a very stable and based economy.
So, sorry Neelkanth, I'll just jump in here because lots of technical terms came in. So maybe we should spend time on this M0, M1, M2 just
before we move on.
Before we move on, right?
So M0 is base money.
Right.
It is currency in circulation plus banks' deposits with the central bank, right? So sometimes the banks, when they so like our bank, if say we got 100 rupees of extra deposits today, and the extra money we lent out is only 60, we have 40 rupees left at the end of the day, and we can lend it to someone else in the overnight market, or we can just give it back to the RBI that keep it parked so that I need it tomorrow.
And also banks have these statutory reserves like the CRR.
CRR
is also part of this.
Correct, exactly. So these are reserves that you keep at the central bank. So if you add those, that becomes base money. So at a very broad level, you can say it is currency in circulation,
right?
Coins and notes and all that. Over that, if you add demand deposits, then you get to a different definition, which is called M1.
And demand deposits is savings accounts and current accounts.
Correct. That it's very liquid.
Right.
That you can get access to it very quickly. Right. Because currency in circulation, or the physical currency, is the most liquid of all money. Demand deposits can also be money because you can exchange it for currency with very little friction. If you add some more friction, you get to M2, which is where you add time deposits.
Which are fixed deposits, FDs.
Fixed deposits and FDs and all that, because you cannot liquidate it
that easily.
Right? That easily. If you add to that money market funds, then you get to M3.
Right.
Because there are money market funds also with a 1-2 day lag, you can get access to that money.
Which are like this overnight funds, etc. That people can, like corporates. A lot of corporates park money into the money market funds.
Right. Yes. And then there are other higher measures called M4. For example, if you are holding someone's loan, now if you want to add all of that, then it becomes M4. But from a monetary management perspective, most countries stop at M2 and M3.
Right.
Because those are the liquid forms of money which in some ways the central bank can control. So coming back to your first question, if your nominal GDP growth, that is the value of your total output, not just the volume is real GDP, value is real GDP plus price growth. If the volume of or the value of your economy is growing at say 10 or 12%, then it is reasonable to assume that broad money growth or M2 or M3 growth. So some countries target M2, some countries target M3. India does M3, US does M2. That growth should be in line with nominal GDP growth. There is also this issue of currency in circulation. Now, currency in circulation is something which is more demand driven. So it is more a replenishment based system. Basically, if too many people or if a lot of people start withdrawing money from ATMs go empty, then the banks need to replenish that, and then they will all go to the regional RBI office, demand more currency, and then that whole supply chain then goes back to the central mint, more currency is printed and starts to get circulated. But what the central banks target is M0 as well as broad money growth.
Right.